Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 17th of 2024. It's good to be with you after, again, another couple weeks break from having traveled and then getting caught up on things, but wanted to kind of bring you up to speed on some perceptions following the election here. And this chart shows us from TS Lombard some estimated impacts on certain foreign entities based on certain categories. And so, we've got a couple of charts on this. You can see, the red areas being negative impact, and you can see trade on EU, China, Mexico being most notably negative. Mexico being negative on several fronts with regard to fiscal, monetary policy, geopolitics, as well. Certain notable positives, though, fiscal policy from a Trump administration related to the European Union. So while there are some negative impacts, there are certainly some positive potential lateral impacts of a Trump 2.0 administration here. You can see on balance, though, there's some slightly negative impacts certainly with regard to monetary policy should tariffs be instituted widely as has been advertised. And that might be inflationary, which certainly could create some U.S. dollar and trade imbalances for some of these countries around the world, which is hence the kind of the overall negative feeling on monetary policy there. But trade also in that same bucket there too, with the exception of Brazil. So there's a lot of data on this slide. A lot of people still trying to sift through the ramifications from a global investing perspective, but as we'll see later on in the chart pack, there is a massive differential in valuations and a massive underweight of investment in international relative to the domestic investment landscape, as well as valuations being completely dislocated as well. Another chart looking at impacts here. We've got estimated hit from tariffs. You saw in the last chart that Mexico was adversely impacted on a lot of those categories, and you can see here that this is certainly the case on this particular study as well. You can see Canada, the other NAFTA partner here, also being adversely impacted. I happen to be a kind of a free trade advocate, so these tariffs do bother me a little bit, and certainly the rhetoric is pretty acidic. You can see down here as we get into China, the potential for 60% tariffs overall and maybe 100% on certain categories, just seems pretty draconian. But you can see the impacts are pretty broad, and just leave it at that, just pretty broad. You've got some areas that Malaysia, Thailand, Vietnam, which is big for manufacturing, non-China related manufacturing. And you can see the impact over here on estimated trade flows to the U.S. being adversely impacted by these tariffs that are being discussed. Now, granted, we've had tariffs for quite a number of years, and the Biden administration, if anything, almost doubled down on tariffs and added new tariffs to the pie. So we have a protectionist administration that is coming in that is essentially replacing one that was also quite protectionist as well. So we'll just have to monitor these negative impacts. Again, like I said in the last slide, you've got I think a long-term opportunity in international investing, although this chart clearly highlights the fact that that there are going to be some kind of near-term things that we're just going to have to work through. So as we talk about trade and policy uncertainty, you can see that here in the green line. That is creating more European economic policy uncertainty. So you can see both of these are moving higher. This is something that we certainly would have expected with a Trump victory. And obviously the markets quite certainly were expecting a very tight race, a contentious race that might not have been necessarily already decided by now, but that was not the case. The signals were pretty clear coming out of November 6th, and so you can see that that policy uncertainty is moving higher. Now, with that as well, we've seen a little bit of a punch here in the, this is the MOVE index, so this is a measure of bond market volatility. So we've seen a little bit of an uptick there, and but overall volatility has been relatively subdued, not only before the election, but after the election as well. In fact, you could argue that that volatility is just abnormally low given this level of uncertainty. So let's talk about inflation, and it remains a little bit sticky. Overall trend is down. You can see, as we look at a multi-year basis, this is monthly data looking over a number of years, that trend line is certainly looking down following 2021. You can see core also moving down, but core CPI. I think there was a relief from the market that this number wasn't really out of line. It was pretty much as expected. And maybe the overall CPI number was a little bit higher, but there were certain elements like used cars that had an outsized influence on the fact that this was an uptick month over month. And the bottom line here is I don't think that we need to worry too much at this point, about a resurgence of inflation. The overall trend is, down, but we're at the stickiest parts of inflation. As we'll see, rents are still high and real wages are still high, as you've heard me say many, many times, that those are the stickiest elements of inflation. So shelter is still an issue. All right, here's a CPI categorical breakdown. You can see, as we talked about in that last slide, used cars and trucks had a really outsized influence in the latest reading, and then airline fares were also up, and maybe some of that's seasonal. You'd expect it with the holidays coming up and some of the bookings therein, but you can see electricity, motor vehicle maintenance, saw dairy and cereal, although we'll see food costs are actually, grocery costs are actually down. So it's a bit of a mixed bag, and of course here's the overall number here, but you can see 2.7 and 3.2%. Airline fares are a smaller percentage category, and then used cars and trucks are, anytime you get a number that's that high for 1 month, it's obviously going to influence this number. So if you actually back out this number in particular, then inflation certainly would have been in line, if not below expectations. Here we have a kind of a concentration view of the components of inflation, and you can see here, this is a year over year. So what we've been looking at in the last couple of charts has been monthly data. So if you look year over year, the way to read this is you've got inflation rate on the x-axis, and then you have their weighting on the y-axis, and you can see here housing remains an outsized influence because that overall inflation weight is about 4.5% on a year-over-year basis. And if you look at its weighting, and this is housing in its various components, this is owner's equivalent rent and some of the tangential spending that goes along with housing, that's about 45%. So very influential. And then you can see some of these other areas that have been really strong lately, anywhere between like 3.25 to 3.5 here, medical care, other goods and services, but a smaller weight overall. So obviously housing is important. Food and beverages is very important, but we know that that's extremely volatile. So in the core reading, food and beverage gets largely taken out of that equation. But you can see that some of these other areas that really haven't been very, not only very influential, but not very inflationary in their own right. You can see these, certainly transport has been on the negative side at a reasonable about 15 to 17% weight. So you can see when you talk about inflation, it's important to look at the components, and again, it's not a linear read through all categories. You clearly see here that some categories that feed into inflation are actually pretty benign right now, and it's just a few areas that have and deservedly should come under the microscope. Now we look at diffusion again in kind of a different way, and this is really, I think, in some respects corroborates what we've seen in the last couple charts. You can see the 12-month rate of change in inflation. This is a moving average, and that's why it tends to be a little bit more smooth here. And then we see the 3-month number in this line here, but this represents the percentage of sub indices where the 3-month rate of change is above the 12-month rate of change. And you can see here the 3-month has been coming down. The rate of change has been coming down. That number currently is about 50%, and it's been on the decline. 12-month rate of change has been moving a little bit higher, but you can see this inflection point here is that the percentage of sub indices where that short-term rate of change is higher than the long-term rate of change is still going down. So I mentioned this. This is actually grocery prices. You can see, highly inflationary as we were in 2022, 2023. You can see that number came down. We had a little bit of a kind of a head fake, kind of a false positive here on reinflation. But then we've had data points that have gone down, and we actually had a negative print here for the first time that we've seen since 2019, 2020. And you can see that food inflation, or as measured by grocery prices, is usually pretty benign, but we just had some dislocations here, and now we're back in the negative. So I think that's pretty profound from an inflation standpoint. Here we have core goods prices, and those were up slightly. They were up about 0.05% here. So really not that much, but it was positive when we've seen a whole bunch of negative data points. And if you back out commodities within the CPU, and you back out used cars and food and energy, that number was actually negative. So from a good standpoint, even though it uptick, it was led by used cars, which we've talked about at least 2 or 3 times now in this chart pack, but also food and energy, which we just saw with grocery prices, were actually negative for the first time in a while. The overall goods-related inflation has really gone negative here. Here we have core services CPI, which is on the flip side of the goods number. So this represents services, and we know that number has been a little bit stickier here. And you can see, the rent of a primary residence, boom, there you go, slight uptick. But this number, overall trend is down, but it just seems to not be moving down as fast as maybe we would have expected, because we see observed rents of residences like apartment rents, which is a little bit different from this definition here, but apartment rents have actually been negative to flat, and we thought that the data would catch up. This data would catch up with it, but it's been a little pokey. But again, this is higher than what we saw pre-pandemic, although it's getting kind of closer in line. You can see OER, owner's equivalent rent of a primary residence. You can see that number remains sticky, and so that has an influence on the services side of things. Now here we have producer prices, and we just jump straight to it because this is really what has the kind of the punch in the data here, and it's the core PPI. And again, backing out the food and energy components, you could see that the number was a little bit ahead of expectations, although not egregiously so. We've had a little bit of a blip, but we have seen kind of this weird, kind of this odd trend line down. I mean, the data on the producer side has been a little bit lumpier than the consumer side. And of course, if we back out trade services on a month over month for producer prices, producer price index is what PPI stands for, that the actual number has been slightly ahead, was slightly ahead of expectations in the October reading. Here we have the current pricing for Fed funds looking into 2025. And so that number is in this red line. So we just started kind of evaluating what that number was looking like when we headed into the fall. This is in this purple line here. This is the market pricing for year-end 2024 pricing. And so now that we've basically, had the second to last meeting for the year, we expect the Fed to remain roughly flat, although I do see some modest probability of a rate decrease. But I think with the Trump victory coupled with unified Congress here, I think the Fed is pretty well content, should be pretty well content to sit on their hands at the next meeting. So here we are ending the year at, this is the Fed funds current rate as we're showing it now. It's really more 4.25 to 4.5. And we're looking for the Fed at most in their meeting in December to decrease rates another 25 basis points. But again, like I said, I think there's a decent chance that they do nothing. But having said that, the current market pricing for Fed funds is about 3.9 right now for year end next year, which is about 50 basis points, or a little bit more than half of 1%. So basically the market is pricing in only a 0.5% decrease in rates over the next year. Now we'll look at average weekly earnings year over year. We talked about wages being sticky, and we see that real wages are actually moving higher. Latest reading October was plus 1.4%. And again, these are real, so these are really net of inflation, and good for consumers, good for savers. For the most part, it does fuel consumption, but it is a measure of inflation that we do have to take in stock. On the flip side of that, we see 90 days delinquent credit card debt beginning to eke up. When this number was like here and showing this inflection point, I wasn't terribly concerned. I'm not like really crazy concerned right now, although, you could see 2008, global financial crisis was kind of here, and then we saw that number really spike. And, obviously I don't know, I would not want to get back to this point, but this is something that we should be watching. So, even though we got real wages positive, we do have retail sales moving higher. We do have these kind of delinquency indicators that we need to be aware of heading into the new year. A little bit of a busy chart here, but this is University of Michigan sentiment figures for the blue line represents buying conditions for vehicles. The amber line represents buying conditions for houses, and then the white line represents buying conditions for big household durables like washing machines and refrigerators and things like that. You can see here that plummeted in the wake of the pandemic, and you can see housing with interest rates moving higher and housing prices moving higher, that buying conditions remain relatively soft, although we've seen a little fishtail hook up in all of these categories. You can see vehicles has been pretty stable for the most part. You can see that household durables, that has clearly looked better than the other two sectors, and that's why I think in some respects you see some increase in capital spending in the manufacturing sector for new capacity, because these numbers seem to have recovered somewhat, but clearly the housing number is something that we pay attention to a lot, and deservedly so, because it does represent a lot of tangential spending. Okay, talking about housing, we have the Mortgage Bankers Association MBA Purchase Index, and we're really hugging these kind of weak levels that we saw in 2023. So it's still a tough market. Certainly, whether you take stock of these numbers or the chart that I just showed you on buying conditions, this is kind of like the after buying conditions are really kind of setting the stage for what this data is expected to look like. And we expect it to remain soft. And of course, we're in the cyclical low point of the year here, so that data likely continue to trend to 2023 levels. Similarly, on the refinance side, we have it's a little bit better picture because we did get some relief in interest rates during this period over the last couple of months. However, that has clearly reversed. We've had interest rates moving higher, mortgage rates moving higher as a result of increases in the 10-year Treasury. And so that index is moving lower once again. Interesting chart that I saw. It's just more of a kind of a demographic that we see first time and repeat buyers both moving into higher age categories. And so this has, I think, a lot to do with the fact that affordability is lower and buying conditions are lower, that on balance, you're finding that older buyers are more capable of, or people are waiting until they have more resources to buy houses from a first-time basis, and that repeat buyers, which interestingly enough, you can see that this trend has been well established. So this is not a new thing, whereas this is a bit new. So first-time home buyers clearly moving from kind of like call it the 30 years old level to 38. We'll talk about the dollar, and we'll get into investments, and we're going to talk a little bit about commodities. You can see the dollar spot index, U.S. dollar is very, very strong right now, and accelerated following the election, thinking that if you have aggressive tariffs, that might lead to a little bit of unwanted inflation, which in turn would lead to higher interest rates, which in turn would lead to a strong dollar. That's kind of the narrative that we're sitting at right now. So dollar spot index, almost 1290, very strong relative to other currencies across the globe. Bitcoin has also caught a bid. This is a story that just keeps on giving, and if there is a volatile asset here in the investment landscape, it is certainly Bitcoin. I mean, it's no question has had a tremendous rise, but you look at the trend line going back to late 2023, it's very mercuric, but it can be, quite volatile over time. I mean, volatile to the tune of, perhaps 10, 15, 20% over a very, very short period of time. And I think investing has to be done in doses and certainly with a fair amount of caution. Another thing that has developed, interestingly enough, following the election has been, along with this kind of this rise in Bitcoin, has actually been a selling off of gold, which, if you feel like you're heading into risk or feel like you're heading into inflation, gold is typically a good hedge for that. And oddly enough, we see gold acting a little bit differently now following, not only following the election, but just in general, its correlation to the equity markets has been oddly strange, and in some cases non-traditional. But as we see here, clearly an inflection of Bitcoin values versus gold here. And we got some commodity data. You can see iron ore. We are off, even though we've had a several month decline in iron prices. This has something to do with demand from China. So this is more of a global figure that we see here. So latest few data points down, we've got lumber moving higher. This is maybe more of a domestic phenomenon, and has several tangents. Home building is still trying to catch up to demand, which is driving prices for existing homes a lot higher. So lumber prices moving higher, at the same time iron is moving lower. We've got other things like coffee moving higher, You can see that that's been a phenomenon. Some of this has to do with weather and agricultural trends. We've got class 3 milk, which is kind of the primary milk that goes into cheese. Those prices have been coming down for a number of months now. And so you can clearly see that there are some commodities, multiple commodities moving in multiple directions. Now we turn our attention to oil and crude oil here. We've got a lot of data on this chart, so really looking at it from a couple of different perspectives. So we've got inventories which were up slightly in the last month, but we can see crude oil stocks are down really for this time of the year below their 5-year average. And then we look at gasoline inventories, they were down, and so we see gasoline stocks being fairly low. And then distillates, it'd be like kerosene and other things like that, also kind of fitting that same trend. So it is rather interesting at a time where we have lots of domestic drilling that our stocks of oil are pretty low at this point, as well as our derivative products out of oil. And we have seen a decline in gasoline prices to some extent, exiting that shoulder season, but looking into the winter, it looks like those gas prices might be a little bit sticky because stocks are fairly low. Here we have Brent crude prices. This is kind of the manifestation of the global backdrop. We see Brent crude prices being off a little bit. We see natural gas futures, and this is the December contract, have moved higher as of late. This is a chart that I thought was really interesting, and it really, I think, sets the backdrop for 2025 and 2026. You see in black right here, this is like the number of oil rigs and kind of a trend line here. And this is 2023, so it's a little bit dated. This is much more current, but I thought this trend was pretty profound. But you've got shale oil production, which continues to move higher despite a declining rig count, and you can see that that's really kind of manifested here too in production per shale well in the lower 48 states, continuing to move higher over basically a trend that extends well beyond a year here. So lots of productivity in the U.S. oil patch. Now let's talk about the investment markets per se. We've got volatility, which, again, for all intents and purposes, did pick up a little bit before the election, although I have to say that on a relative basis, when we look at 20, that's still pretty low. I mean, historic volatility, you could easily see 22 to 28 here. So we've had relatively low volatility, less so than we would have expected heading into a presidential election. But that has really dropped off, and that's very uncanny. A 14 VIX is pretty close to this historic low of 12, which we were enjoying earlier this year. And again, this kind of sets up, the way this looks like and manifests on the equity price chart is that you have this lazy upward increase in stock prices with very little variation. And we had a little bit more, but still below trend. And then the bottom line here is that in the last the last 6 weeks of the year, we're sitting at a pretty low point on volatility. So let's talk about risk premium. This does give me a little bit of cause. The fact that we have low volatility and we have a very low risk premium. In fact, we haven't seen a risk premium this low since 2002. In fact, the risk premium is negative. And so what am I talking about here? So this is basically the earnings yield on the S&P 500, and think of the inverse of price to earnings. This would be the earnings to price. So earnings over the value of the index. And this is that measure, the earnings yield minus the 10-year treasury, which we know has been moving higher. And so when you take the earnings yield and you subtract the 10-year Treasury, you have seen a consistent decline in that risk premium. And what that means is the market is fairly complacent. And you see that in the volatility indicator. Not a lot of volatility, risk premiums pretty low, and in equities, just on balance, looking at the S&P on its surface, maybe a little frothy here, and we might be prone. And I do think that we're looking ahead to increased volatility factors here. This chart is something else that kind of reinforces what I've been talking about on that last slide. You can see the name exposure index, and this is just basically a measure of enthusiasm in investments. And this is institutional. These are institutional investors. You can see that exposure index to stocks, they're much more enthusiastic about the equity market overall. But then this figure from, or this chart from MRB, again, talking about the S&P 500, is something that I think sets the stage for more volatility down the road. Obviously, we've had a stock market with just this is multi-year, but just look at it over the last year or so. We've had a stock market that's moved consistently higher with very little interruption. We've also had price to earnings move higher. And again, the higher the price to earnings, the lower the earnings yield is. And so we're, because it's the inverse. So we're now up to 22, and then long-term earnings growth has moved higher at the same time that forward profit margin expectations are at historic highs. And so what this sets the stage for is, things have to be kind of perfect, if you will. If we have earnings growth that falters here, then that's going to bring valuations down, and it's going to introduce more volatility in the equity markets. And the fact that, that we're moving higher on all of these things is something that is definitely worth paying attention to. Now, this speaks to the entire S&P 500, which we know is essentially weighted pretty heavily to high growth technology stocks. And so we've got to be careful in making the assessments that this speaks for all stocks, because it absolutely does not. In fact, I think that when you look at these ratios for like the equal weighted S&P 500, these measures are all much more agreeable. But as it relates to the entire index and the fact that a lot of portfolios get benchmarked to what happens in the overall index, I just throw this out as just a little note of caution here. Here we have market breadth, which largely has improved. This red line is the percent of members above their 200-day moving average. You can see that number, although apologies here, I blew this chart up and it kind of blurred it a little bit, but we've got about 80% of the market that's above its 200-day moving average. Maybe that number's coming off a little bit, but as the market goes up, you want to have more of the companies participating in that growth. It's just that the market's moving higher at its current pace because you've got those highly concentrated tech stocks, which are increasing at a faster pace. Here we have inflows into large cap equity funds. We've got record inflows, and so that's crowding that trade. And those large cap equity funds, again, in many cases are dominated by those AI linked large cap technology stocks in there. And so, but obviously it's becoming a crowded trade, so we got to pay attention to that. Here we have global equities. I referred to this earlier in the chart pack. So the U.S. share of global equity market capitalization at a 50-year high. And this has been playing out for the last decade, but global equity market capitalization of percent of the global economy is also at a high. And so, and then you look at this, basically the global stock price performance relative to U.S. price performance, and there really is no question. I mean, this is like almost like 1 in 1,000. It is so rare to see these levels, and the degree to which U.S. markets have outperformed international markets, and I do believe in the theories of mean reversion, and so you get these numbers and these numbers that I do think that you're going to have better performance on the margin for international stocks looking out over the next several years. It really is a law of average. So I do think that there are opportunities in international investing, even though there may not be a catalyst that's staring you directly in the face right now. We have small caps. This is a sentiment indicator from global fund managers that expects that the Trump administration is going to be good for small companies. And I would tend to agree with that. I think, once we get past some of the issues related to what tariffs are really going to look like, and then once people get used to those tariffs, then maybe the economic situation stabilizes, and anytime you have a more stable economic backdrop with interest rates that are perhaps more predictable, that's a good scenario for small caps, and I would tend to agree with this assessment here. Interesting data point here. We've got basically you've heard me talk about the supply of equities, and that represents the number of publicly traded companies in the U.S. And back in the 90s, before the tech bubble, we had over 8,000 listed stocks, and that number has fallen to about 4,000. And so we basically have taken out half of the publicly traded institutions out there, and some of this is due to buyouts, some of this is due to companies going away, some of these are related to private equity and taking these companies private, but there's been a lot of consolidation, and I think that's an interesting data point when you talk about pension funds and index funds that have to go buy index members, and if you have a smaller supply, this is one reason why we've had some tailwind behind equities over the last probably 5 to 10 years, notwithstanding the pandemic recession, is because the supply of equities has gone down quite a bit. And so you've got more funds chasing fewer opportunities. Here we have government yields. We've got the 2-year right here. We've got the 10-year right here. Both have moved higher. This was moving higher even preceding the election. You can see the 10-year had a more pronounced move. So we've got interest rates moving back higher. So when all of this was happening, mortgage rates were going down, and affordability, relatively speaking, was better from a housing market standpoint. That has reversed to some degree. You see higher interest rates because you've got overall short-term rates. The estimates, as I mentioned before, the market's only pricing in a 0.5 percentage point in short-term rates over the next year, and so that in some respects helps to drive longer-term rate expectations higher. But you also have this feeling again that we're not going to be lowering shorter-term rates nearly as much as was thought 12 months ago. Here we have Treasury yields that typically after the beginning of an easing cycle, Fed typically starts easing credit when you run into a slowdown, and that wasn't the case. We've had somewhat of an acceleration in economic growth, and so you've actually oddly seen interest rates moving higher after the beginning of the rate easing cycle. Now these are 10-year yields, so just to be clear, when the Fed starts lowering very short-term rates, usually long-term rates follow, but that's not been the case this time. They've moved higher. And then also we've seen a higher sensitivity of bond rate changes and bond yields to various economic surprises. And this goes back to 2003, and you can see probably the average falls right about here, but clearly we've been higher than that. And that's why when we talk about the bond market has had more volatility than the equity market, that's absolutely true. And we see that play out right here. Here we have high yield credit spreads, and we've talked about this several times before. And this is just uncanny. This is like an average, and then these bands here represent one standard deviation. So you're going to expect that basically, 2/3 of all observations are going to fall within these two lines here. They're going to fall, within one standard deviation of the average. Well, we're now punching through that, and it's very rare to see credit spreads this low. And it also serves as a measure of complacency and whatnot in the market, which I think, again, we looked at all those measures on the equity side for the S&P 500, it just seems like things are getting too frothy. Well, this is another measure of that. This is a measure of complacency that you don't see if the market was maybe pricing in more economic and more fundamental turbulence for these companies, which is most certainly not at this juncture. Lastly, I want to show you this chart because immigration is now in the crosshairs with the Trump administration getting set to take over. And what's really interested, this is actually, I believe, a Kansas City Fed a report or a presentation of some sort. But what's interesting here is that you've seen really kind of almost flattish growth in the contribution to the labor supply of immigrants that have very little or no formal education, and whether it be some college, some high school, or a high school degree, we've seen kind of almost a flatlining here. So that really hasn't been the immigration that we've seen, and that happens to be the immigration that I think the Trump administration is targeting right here. What we have has been an absolute surge in highly educated folks here, and I think that's really interesting, and so we're seeing higher immigration from people that are actually helping to make products, helping to ship products, helping to design and manufacture products. You've got a lot more of the highly skilled and highly educated immigration folks that are going to be relying on HB1 visas and other forms of visas, and I think that would be a negative impact to the economy to shut that off, and because of some type of populist narrative. And I'm not trying to make a political statement. I'm just looking at this data and saying that we need these educated immigrants to help make our economy go. Well, that's all the charts that we have for this week. Hope you've enjoyed that. A lot of meat in this week's data. So anyway, hope you have a great week, and we'll talk to you again soon. Take care.